Well, I'm looking forward to your session because I have a self-directed IRA and want to know more. And I know there's a lot of people on here that are in that same boat and have lots of questions surrounding it. And I'm sure you are going to help us out in multiple areas as it relates to self-directed IRAs. So do you have a PowerPoint you're going to present to us?
Yeah, I have a PowerPoint. They're getting ready to pull it up. I got people milling around me right now
Sure.
because I'm pretty not good at these type of things. I was going to say, as I do it, if there's something that comes on that's like you want to pop in or ask me a question or stop me, you know, because there might be something that just reminds you of something, feel free to do that. You know, the whole idea is that we all learn how to do this better and make more money and have more fun and be safer and all of those type of things.
And I'm going to get to one thing here. So you have your screen on there, so that's good. That means your technology is working, so that's always fun. I have one thing to do on my end, and I'm going to introduce you a little bit further. And as long as
that made my IT guy very happy. He's smiling here.
Good, good.
Pleased with himself, apparently.
Well, that's great that you have an IT guy. I'm pretty much my IT guy, so that's kind of how it works.
Yeah, that wouldn't work.
Let's see here. One second here. Just switching over. I'm just typing something on here on the Facebook thing. This is being shared on our closed Facebook group only, so that people who might want to be watching it on Facebook instead of on the Zoom platform, they can do that. And ready to buy. All right. So we should be good here. I'm going to do an introduction of Mr. Nathan Long here. And let's see. There it is. Nathan. Nathan is the CEO of Quest Trust Company. And he was referred to me by a mutual friend, Scott Carson. I'm sure you know him very well. He was the one that originally gave me the idea to do this summit. So he's been doing it for quite some time. I know he's had you on his summit several times as well, and he speaks very highly of your company. And I'm actually looking into your company as well for my, doing some of my stuff with my self-directed. So Nathan is the CEO of Quest Trust Company, overseeing the operations of the company and aiding in the improvement of practices implemented. He has aided in growing the company to over 90 employees located in 4 different cities with continued expansions expected. He holds the title of Certified IRA Services Professional, CISP from the Institute of Certified Bankers. Nathan, take it away for us.
Woo, I sound great, don't I?
Well, and just so you know, I will be in the background in case you have any problems or issues, but I'm sure your IT guy will help you too.
Sure, no problem. But I mean, no, he left. I'm in the room with the microphone and by myself.
I'll be your virtual tech guy.
You'll be my pal. Hang in there with me, Dan.
I will.
No, so just again, my name's Nathan. I'm president of Quest Trust Company. We've been doing this for a long time. A lot of people don't understand that sometimes when we're talking about, especially when we're talking about commercial properties, what a big piece people's retirement accounts can make in there. We do have to understand some rules for dealing with it and how and what to do, but they're not too difficult to deal with it if you're using the right people. It's not very expensive. The average self-directed person spends a few $100s in fees per year and is great filling in a lot of pieces with commercial properties and could do a whole lot. So hopefully this little bit of education will teach you a lot about the roles that retirement accounts can play, and what you can and can't do in a very general sense. If you need more information than that, it's always free to put in a call to one of our IRA specialists to review your specific situation, whether you're a client or not. Look at that, I got a disclaimer down there. But Quest Trust Company, we don't provide any tax, legal, or investment advice. A lot of people don't understand. We have a lot of education seminars and stuff that we put on, but we really don't sell anything at Quest. We're like a service company. We make our money off of transactional fees. So when someone buys an asset with our IRA, we have a transaction fee associated with that and fees associated with going for the year. And that's how we make our money. And we make money when people invest in things that are good investments. We also make money whenever people invest in things that are bad investments. It's important to do your own due diligence, right? At Quest, we're legally obligated. And this is true of any self-directed custodian. Whatever you tell them to invest in, they must. Pardon me. So if you give it to them in writing, that's what they got to do, even if they disagree with it or anything else. So it's really important to understand that they're not doing the due diligence, no matter how much education that we try to provide for you. So what I'm going to try to teach is how to use a self-directed IRA to increase your own personal wealth. So part of this is how to use your retirement accounts, the things that you and your family have, in order to invest in commercial property. But part of the other thing that I'm trying to teach is how to use other people's IRAs to invest in your commercial properties if you're the lead, and what you can do in the role, and where to find information and stuff. I'll talk a lot about that as we go along. So one of the things I'll start with is just some basic information about IRAs or self-directed IRAs. You have to have a little bit of understanding. The term self-directed is really just a marketing term. There's really no such thing as a self-directed IRA. An IRA is an IRA is an IRA, I like to say. There's the rules that govern an IRA with Quest and the rules that govern an IRA with any other institution that you may be familiar with are exactly the same. You know, have to try to be FDIC sure. There's oversight from the banking commission and so forth and so on. It all works the same. So what would be the difference between an account with Charles Schwab or Edward Jones or Fidelity or one of these types of companies and an account with Quest IRA is we only hold private assets while they only hold publicly traded assets. They're licensed securities agents. They have a job. They're selling you assets. Those assets are the ones you're usually familiar about: stocks, bonds, mutual funds, CDs. I'm not picking on them. I'm trying to describe what they do. At Quest, we hold private assets, and we must maintain ourselves as a complete neutral third party, and we can't sell those assets to you. We can't do anything with them. We make our money, like I said, off of service fees related to buying and selling those transactions. Got a frog in my throat, I'm sorry. So at Quest, one of the things I want you to take away from this slide is that most of my clients have an account in both places. They might have an account with Charles Schwab, have an account with Quest. Whenever they need money to do something at Quest, we transfer it over from Charles Schwab over to Quest. We use that money as that investment pays out or pays off and money builds up, cash dollar builds up in the Quest account. Typically, you would transfer that back over to your traditional custodian. So it's really important to understand that to do that, because some people, you don't have to move your whole account over or all the money that you have over to do an investment there. All you have to do is move exactly what you need. Quest doesn't require you to have any cash holdings or anything like that as you do it. There is something I want you to be aware of as you're thinking about this process, which is how long it takes to move money from one account to the other. Do an IRA to IRA transfer can greatly vary depending on the institution that's sending the money. A lot of the institutions actually can move very, very quickly. I'm kind of picking on Charles Schwab, Fidelity. I mentioned those guys. Those guys are pretty fast. So in less than a week, I can usually get the funds transferred. We can get it sit in a wire so that it can be easier access and things like that. There's other companies out there that are a little bit more difficult. Matter of fact, it could take up to weeks to move that same amount of money. And sometimes that can mess up a deal if we're not paying attention to how long it takes to move that money. And of course, I certainly wouldn't mention any of their names. Wells Fargo, sorry, had to sneeze, or anything like that. But they are out there. There are certain ones that take a little bit longer than some of the others. But a self-directed IRA really isn't a type of account. It's just to describe what types of accounts there are. There are a lot of accounts that can be self-directed. We'll look at that in a second. Why would you want a self-directed IRA? Well, I think it allows for diversification. I know everyone says you should diversify your portfolio. which is kind of funny. I'm not very good at this because all my personal holdings fall into two categories. You mentioned Scott Carson. I buy notes and I buy commercial properties. I am not a rental guy type of guy. I know a lot of people, there's a lot of money to be made in that. There's other people out there that are great for that, but I like passive investments. So that's me personally. I put all my eggs in one basket, but if you're looking at most portfolios, you should have some diversification in there, and everyone's always talking about diversification, and it's kind of interesting. And then they don't have any of their portfolio in real estate. It's all publicly traded assets, stocks, bonds, and mutual funds in different classes, but not any actual holdings in real estate. And again, don't get me wrong. I don't think everyone needs to run out and become a rental property manager. I mean, there are people who are really good at it, and there are people that are really bad at it, like me. And it doesn't work, but there's all different types of ways that we can hold some real estate. And real estate is the largest segment of our economy inside of our retirement accounts. One of the great ways is commercial properties. It is buying as a passive investor, and we'll see some of that as we go along, but it really allows for what I call true diversification. Right? Of course, everything that you're thinking about as you do investing, if you can figure out how to have that money grow either tax-free or tax-deferred, it does make a great amount of difference. And Quest helps a lot with that. And it's kind of nice sometimes talking to an IRA specialist at Quest because they never have a horse in the game. The decisions you make with your investments don't affect them at all, but they're highly knowledgeable about both investments as well as IRAs and the tax consequences and things that occur. And so it's a real relief or nice to be able to get some information about the tax savings. But I think that there's something else that a lot of people don't think about, and that I personally have spent a lot of time thinking about when I do an investment into real estate like commercial property that a lot of people don't even consider. Most of the time when I'm investing with someone, my real estate investor is taking a building that maybe is being undermanaged. It maybe has some deferred maintenance in it, some issues like that. It could be a blight in the community, often in the community where I live, work, and play. And when I invest in that, I'm not only making money or making a profit on that, I'm investing kind of back into my own community. I know what my investment is affecting. They're taking this apartment complex or other commercial type property. We're building it. We're fixing it up. We're making it a better place. We're providing jobs. I'm investing into my own community. A lot of times if I'm doing like stocks or bonds, the average American doesn't really even know what they're investing in, like just throwing a blanket over these large mutual funds. And often what happens is you can be investing with companies that aren't aligned with either your ethical or your political intentions. And that happens a lot. You vote a lot with your money. And I know one time I had an international aggressive growth fund, and I was shocked at some of the things that I had invested in unbeknownst to me. They were profitable things, but not things that were very appealing to me, either socially or politically. And so when I self-direct, whenever I do these investments one at a time, I can literally drive past them. I could see them. I could see the progress that's being made, and besides the profit that I'm getting, besides the fact that I'm investing into an asset that's secured by real property, I'm actually can see the help that I'm doing in the community where I live, work, and play. And I think that's important. I think it's something that a lot of people don't think about. You just buy a mutual fund, you might be buying 80 companies, and only maybe 30 of those might, be aligned with the type of business you like to see done. Took too much time on that slide, sorry. But one of the biggest things is also I think it allows you to take control of your environment. If you're investing in things that you know and understand, if you know a little bit about real estate or know a little bit about these things, you tend to do better with specific investing than if you are, like I said, just throwing a blanket across a group of investments and hoping for the best. So if a self-directed IRA isn't a type of IRA, there's all types of IRAs that can be self-directed. And we break them up into different categories. I'm going to spend a lot talking about the first category, which is personal plans, because honestly, that's where most of the retirement money use for investing comes from. Because with the traditional IRA, that's a tax deferred account. That would include rollovers. So if you had a 401k, a 403b, a thrift savings plan, a 457 plan, I can keep naming the different types of qualified plan. Basically, you put some money in, your employer puts some money in, everybody gets a tax deduction, and over a period of years, it grows into a larger bucket. As that matures, as you've had separation of service, you've left your job, or something else has occurred, that will fall into what we call a traditional IRA. So it's actually most of the investing occurs from that. The Quest, we talk a lot about the Roth IRA. I honestly think the Roth IRA is a wealth building foundation. Everybody in America should have a Roth IRA. There are income limits on it, but we can do conversions from traditional IRAs to Roth IRAs, and there's no income limits on that. So everybody could always have a Roth IRA. And some of your investing should be done from the Roth IRA, or us paying our taxes now instead of later. Why? Well, because taxes tend to go up. And why pay the taxes before you invest? Why not pay the taxes before you invest on the smaller amount of money versus taxes later once you've grown it into a large amount of money? And the answer that some people would give is this, is if we're doing an investment and we ever considered having a Roth IRA, which grows completely tax-free for the rest of our lives, there's no RMDs, and I can pass it to my children in that same tax-free state in which it continued to grow tax-free. All very powerful concepts. The problem with it is for some people, they don't get very much return on their retirement money because they're being very safe with it, keeping it in CDs and stocks and mutual funds, or not mutual funds, but bond funds. These are guaranteed type of rates that provide very low returns. If we converted from a traditional IRA to a Roth IRA, we would have to pay tax on that amount, and it could greatly be a lot of tax if we've already had modified adjusted growth income that year. But once we apply the concept of buying into commercial property, this means that the difference here is we're going to build our wealth faster. All right. I'm not here to tell you how that works. That's Dan's job. But I mean, I'm trying to apply the thinking is once I have this, once I'm getting greater returns, as the returns increase, then the argument for paying my taxes now becomes greater and greater. Because if I could pay my taxes before I invest, into a thing, which can be painful sometimes. And you can also, a lot of people don't realize this, with a conversion, you don't have to do it all. Let's say if I had $100,000 buy-in, I could convert only $25,000 and have 25 in my Roth and 100,000 in my traditional, or 75,000 in my traditional IRA, and continue to do that investment. Maybe the next year convert a little bit more. But I think it makes a lot of sense to work on having your Roth IRA. We have a lot of classes about how to analyze Roth IRAs, and I don't want to spend all my time on that. I want to talk about it, that traditional and Roth IRAs can both be invested, as well as these employer type of plans like SEP IRAs, simple IRAs, or we have this really powerful product called the individual 401k or the individual Roth 401k. These are if you're self-employed or have a small business, not where you have a 401k like at work. If you're self-employed, you can use these types of plans to also self-direct. And one that I could probably spend the rest of the time talking about that people never think about investing as a self-directed IRA are something called covered education accounts. These are education accounts for minor children. They're very flexible because they do cover expenses kindergarten through college, and they're great for this. And a health savings account. Health savings accounts grow completely tax-free. They're not like the flexible spending accounts where you had to use them or use them. You can invest with these accounts and continue to grow that year after year, and years in the future take out the money from things. We have a class about both these things, and all of these accounts can be self-directed. And one of the things that people miss when, got off on things, is that when we're self-directing, one of the things I love to do is to partner all these different types of accounts together. If I had someone come to me and they said they needed $100,000 buy-in as a preferred investor on an apartment complex deal or something, I would probably come up with all of that from my personal IRAs, but those IRAs might be my Roth IRA, some money from my wife's Roth IRA. I have a cousin that has a traditional IRA I invest a lot with. My mom has a traditional IRA, and we would look at see who has the different cash balances, and maybe each of us put all that in to the investment entity. Quest is filling that as a $100,000. So we can combine accounts in the same family to create enough money to provide for one buy-in, which is nice and fun. And it also allows something different. I've been doing this for a long time, so it allows your children to participate at a very young age at something that they normally wouldn't allowed to do. You can take their Coverdell or their a Roth IRA, assuming they had some income, and put a little bit of money in with it and allow them to partner with you on an investment and see how that works. And what a great education that is. I'm using the term IRAs from the rest of the point of this speech, but I really mean all the accounts that I just talked about. There are restrictions on these accounts, and we have to understand them, though they're not too difficult to understand, to tell you the truth. There are people restrictions, transaction restrictions, and investment restrictions. And I think a lot of people make this a lot more complicated than it really is. We've got to start with the people restrictions. There are people who are disqualified from actually doing business with the IRA, and we deem them as disqualified persons. Well, if we're talking to them, what does it mean that they can't do? Well, they can't buy anything from the IRA as an entity. They can't sell anything to the IRA. They can't extend services or receive a benefit directly or indirectly from the investment that the IRA makes. Well, who are these disqualified persons? Well, primarily, it starts with you. You see, your IRA really, it sounds weird. It's not really your money. It's money that's held in trust for you. Till when? Well, till you take it out, right? Until you take it out for a qualified purpose. Hopefully that's retirement. You don't have to take it out before then, because you could have a penalty if you did. But the idea is that we're forced to save, and then we get in some special tax benefits by being responsible and saving for the future. And we're in control of this money. We can tell it to do anything that we want to benefit the account. We can instruct it to buy anything that would be good as an investment for that account, but it can't buy it from you. And let's, for example, if you instructed your IRA to buy a house, you couldn't go live in that particular house. You couldn't, and all the rents that would come back from that wouldn't go to you at all. They go back to the IRA. So as we're using our retirement accounts and we're investing in real estate, we're keeping our retirement account money separate from the investments that we make personally. It's a different category, and it's a different thing. So you are a disqualified person to your IRA, which means you can't buy, sell, trade, extend services, or receive a benefit directly or indirectly. And there's also a group of people who are equally disqualified. That's why I made this simple little chart. No, forget the chart. It's really simple. It's just you and your spouse. It's your children and parents, their spouses, and companies those people own, control, manage, or highly compensated by. Notice I didn't say family. And this is really important. If we're going to raise money, we want to know people's IRAs that are be disqualified to me and the people that aren't. So I'm going to repeat that again. You, spouse, children, and parents, their spouses, and companies those people own, control, manage, or considered what's called a highly compensated employee. That's a legal term of art. It really doesn't have anything to do with how much money you're getting paid. Okay. If we understand those, it's really pretty simple. Okay. There are, like I said, transaction restrictions, and guess what, guys? We already talked about them. That's just the things that we can't do, which is prohibited people can't do: buy, sell, loan, trade, or extend services. Done with that conversation. Now there's investment restrictions. Well, what are the investment restrictions? Well, super simple: life insurance and collectibles. Collectibles are deemed as a work of art. Gem or metal, stamp or coin, or here's the best part: an alcoholic beverage collection. Come on, guys. If you're buying booze in your IRA, you got a bigger problem. doesn't affect us at all. The only thing that really gets us is understanding the disqualified people and what they can and can't do. And I'll get into that in some of the examples that I have here. So, I mean, what can a self-directed IRA invest in? Literally anything that you could just about take title to about, except for those two categories of collectibles and life insurance. Right? At Quest, we break it out into 3 different categories, or we have departments because buying these different categories are a little bit different. One is buying real estate. This would be the direct purchase of real estate. It says commercial property in here, but it would only be the commercial property that was typically bought cash. Right? This is actually our smallest thing. Quincy and I talk a lot about real estate strategies. Both notes and private entities are a much larger category of assets that we hold. In private entities, these are, what do we mean by these? This is private stock, limited liability companies, joint ventures, trust. These are typically the type of entities that we're using to purchase commercial building. So what the IRA is buying into is a piece of that. But we also hold like promissory notes of all different types, secured and unsecured, secured by mortgages or deeds of trust and not. Those are just good examples of things that can be self-directed. I think it's important to understand, if we're going to talk about the different portions that we have, typically if we're doing a commercial property, we have a lead investor, right? And he's putting his credit on the line and putting the deal together, and then he's bringing in preferred investors from different sources. If it's you're the lead investor, you should not use your IRA into that investment. That would be improper, in my opinion. Right? Or your spouses or lineal descendants and descendants. You put your IRAs in someone else's deals. Typically, the IRA, in most cases, as we look through here, you're going to see are passive investors. Let's look at some. Actually, these are real investments. These are things that people have done recently, including myself. This is my investment. I did this. I guess it's almost been 7 years now, but there was a shopping center that I purchased in Louisiana. I was only, this isn't it, just a picture I found off the internet, but I was one of about 25, I think, investors. There was a minimum buy-in of $100,000. Some people I've done some commercial property with before. That turned out pretty good over the 6 years. The property didn't flood. I was happy about that. But over the last 6 years, this one's had a pretty good return on investments. They've actually paid out pretty well. But I calculated my total return of $109,000. That did reduce my investment some. Some of it was a return of the equity itself, but I still have an equitable position of $70,000 approximately from what we can figure from last year's K1s and stuff. So for me, this is a very, very typical investment that I see at Quest into a commercial property, including the time zone. That's why I picked it. It's not a super high paying one. It's not a super, thing. It's kind of a middle of the road one where I put the money in. I did not do anything after, making my initial due diligence and deciding I wanted to do the investment. I put the money in and I just sat on it. I've got checks back and there's still a lot of equity and going on the deal. They'll probably take me out of this over the next 9 to 10 months from what I've heard, right? Here's one this is cute. This next slides, I did nothing besides cut and paste a letter from a client of mine. And he bought a commercial property. Now, these clients were pretty good. This is a little bit different way of doing it, okay? Well, they had about $1 million. This is 2 engineers. They're foreign-born, worked hard, very, very good little savers, and they had ended up saving up in cash about $1 million in their IRA. So let's not kid themselves. They had a pretty good chunk of money whenever they started this process. What they then did is they purchased an apartment complex using a non-recourse loan. The IRA borrowed the money. They were able to fix up the process, as you can see here, in about 21 months. They were able to make a net gain of $1.4 million after selling the property. This is pretty amazing to me, they had worked hard their whole lives to come up with $1 million that they had saved. And with some good training and education, they were able to sell this property in a little bit under 2 years and make almost double their over double their retirement account. These people are so happy, and they're so much of the salt of the earth, good people that just really deserve to have that. By the way, they've gone on and they've reinvested into another apartment complex, and they're doubling down and doing it again. And it's really fun to watch them work and do this. It was a really cool deal. Here's one that's a little bit different. I'm trying to tell different stories so you can see different ways that the IRAs can work. Here was a friend of mine. And this friend was looking at commercial property, and he found one that he wanted to buy. It was basically a commercial flip. I mean, it's a warehouse. He was going to put it under contract, and he was using private money. He was going to take IRAs, borrow the money to buy the property and fix it up. I guess there was repairs to the concrete and the roof and some parking structures that would have done pretty well at he thought he could make a pretty good profit on this particular property, and he had investors that were going to back him into it, and he can do it. Well, what happened though is as soon as he started talking to his different investors about one of them stepped up and says, I want to buy the property. I have a use for that particular property right now. Could you just sell me your contract on the property? He thought about it and he said, yeah, I could say the things. I'll just take some money off the table. They agreed on a price on the contract of $83,000. All of a sudden the guy snapped. He's like, oh my God, I'm taking $5,000 and almost overnight, I'm turning it into $83,000. Here's the problem. It was at the end of last year, and he had already had a really good year. His wife was making pretty good money, and so they were in a good tax bracket. And he really didn't have a need for this money immediately right now. He was looking for a longer-term investment. So what he did is he ended up changing his mind, and he opened a traditional IRA, a Roth IRA for himself, and he just had a daughter last year, so he opened a Coverdell education account and put each of them in it. And he did this flip inside of his IRA, and instead of him getting the profit, he made $39,000 tax-free to his Roth IRA, $35,000 to his wife's, and his child's Coverdell education account also got to participate at $3,000. Chris was able to do this and get a great return because he was able to wholesale. Sometimes you can wholesale commercial properties just like this, right? Though the profits are tax-free, he didn't get any benefit right now. He made that choice for that benefit to be later on in his life. And it's also kind of important to understand he really didn't sell anything to himself or anything. It's because he didn't close that he could make that decision to change it to the IRA. He went back to the original seller and said, hey, I was going to buy this in the name of my LLC, and I decided I want to buy it in the name of my IRA. Is that okay? And he changed the original contract, which allowed him to be able to do that. Again, all these are true stories, things that people have been doing with them, right? And I think that's important to understand, is that you can use your IRA. Typically, when you do that, you're using it in someone else's project, or it could be difficult with commercial property. You're going to have a large amount down, do something like debt leverage or wholesaling or doing something else like that. A lot of people, might have heard about this or don't understand it, but at Quest, we're a little bit different than some of the other self-directed IRA companies. And there's people that, Dan, as you get to know us, you'll understand is one of the things is we will process investors faster than anything else. And sometimes that's the most important, especially if you're at the end of a cutoff or something like that. We have to get the money in. As soon as we can get control of that money, we can process it almost immediately and fund faster than anyone else. We have a lot of education and networking events. We're based out of Houston here. We have big education center in Austin and one in Dallas. And we do tons of online education to make sure that you understand it. And you'll find that my staff to be one of the most educated about these types of investments. So you can ask questions and they can provide you tons of education. Don't get that mixed up with advice, right? We're just teaching you what to do. You make the ultimate decision with a self-directed IRA to do it. And we'll never charge an expedited fee for if you have to do something fast or get something in a hurry. And all the education's free even if you're a client or not. You can always call up here and you just have a question about something. We get a lot of questions of people that have accounts with other self-directed companies and they're just confused about something and need someone to talk to. And that's fine too. I'll eventually earn everybody's business. How much does it cost? It's pretty cheap. It's $100 to open an account, and the average person spends maybe $295 a year to hold an asset. That's like the most. You could actually end up spending less. So most people either transfer from an existing IRA or roll it over from 401k or something like that. But a lot of people can just make a contribution. If I didn't have any Roth IRA and I was thinking about buying into an apartment complex with one of my old 401ks or something like that, and I did not have a Roth IRA right now, one of the things I would do is make a contribution for $6,500 for last year, 2018, and add it to my investment and make up 5% of whatever the investment that I was going to make. Why? Because takes two requirements to have a tax-free Roth IRA. One is that you have to have one, right, for 5 tax years. The other is be above the age of 59 and a half. If I open one now and make a contribution for last year, I basically burn off 1 year of that clock. I only have 4 years left because I made a contribution for 2018. If you have any questions about our fee schedule, it looks a little bit more complicated than it is, but because most people just go to this flat fee up here at the lot and pay $295, but our IRA specialists would be happy to go through it and explain it to you. And basically, you just fill out the application, name, rank, and serial number, tell us who gets it when you die, and that can all be done electrically or online. If you have any other questions, feel free to call or ask for me. I don't know if I went too fast or not here, but my name is Nathan, and that is my email. Or you can call our 800 number and just ask for any IRA specialist, and we'll be good to go. Hey, Dan.
I have a couple of questions on here. If you have a few more minutes with us.
I have plenty of time.
Okay, cool. So we have some time up until about 3:15 is when this session is supposed to finish up. So I know that lots of people have questions around this topic, and so I'm just going to ask you as many of these questions as possible, and have you answer as many as we can. And the first question here is from Skylar. He's asking why. He said, "I know why people who manage Roth and traditional IRAs say that you shouldn't do a self-directed IRA is because they're losing the account, but why would a CPA say not to do it?"
Oh, well, they're not. They might be losing the account. Some people actually way overanalyze the investment. And if you're getting a CPA that says this, I would never buy real estate in my self-directed IRA. Typically, here's the reason. It's this. You lose one of the most powerful investment tools of buying why we buy investment real estate is depreciation. They're taking a look at it solely from the purposes of being a tax guy, and they're going, man, why I buy real estate is I get this huge depreciation. If I get it in a self-directed IRA, I don't get use of depreciation, and that sounds powerful. And guess what, Dan? In a lot of ways, he's right. But I'm not a CPA, and I'm more of an investor. I was raised in South Texas, so I'm not quite as smart. And usually somebody that's telling me that is somebody that's really smart. They're like a CPA, a financial planner, and things. And I got to step back and I got to kind of be like, well, sir, I don't quite get that. Because see, here it is. I have this bucket of money. I got this thing of money. It is not a choice of where the bucket of money is. The bucket of money is in my IRA. That's where my money is. Okay. Now, I got two choices. I got to invest it somewhere. If I invest it in stocks, bonds, and mutual funds, I'm not very good at that. I'll be honest with you. I probably just put it there in a bond fund and get 1 or 2%. I wouldn't have very much. But I know a little bit about buying real estate. I'm pretty good at it. Matter of fact, I'm pretty good at doing due diligence. And over a period of time, I've done pretty good at buying commercial properties. I can show you my track record. I get double-digit returns on average with my investments in real estate. So if I take that money and I invest it in real estate, I'm going to have a big bucket of money when I retire. If I don't, I'm going to have a little bucket of money when I retire. Isn't a big bucket of money a little better than a little bucket of money? You know, honestly, they overanalyze the whole thing. And it really is a strange thing, too, because the reason we don't get depreciation is because we don't have any taxation. If we, like, you have to have a taxable event in order to get a tax deduction. But in life, we are the makeups of ourselves. So for me, everything that I do, I always put it through an IRA filter, because that's what I do. I'm a real estate investor, an IRA filter, right? For a CPA or tax guy or tax thing, they're always putting their thought processes through the CPA filter, this tax filter. And sometimes they can't see the forest through the trees is the only thing I can really tell you. There are good CPAs that do understand it, that do it, but then there's also the old crowd that says, oh, I would never do that, it's different, it's really not any different than anything else that you do. And then the last thing I might say is there are times when depreciation does affect our commercial property, or where we could have some taxes in there. And one of the best things about it is then I turn around and use those same strategies. I use this depreciation and I can apply them, and I can use those inside a self-directed IRA, and I often attack any tax problems I have with those things, and I can usually solve them. I know it's maybe more complicated than you wanted to hear.
No, I think that's a good answer, and I think one of the other considerations to think about too is, like you said, you know, the money is sitting in the self-directed, so you really don't have very many options with it when it's not self-directed. You know, it's really just sitting there, and you're basically, whatever your financial advisor or whoever is managing, your IRA is going to tell you what's the best thing to put it in, and that kind of stuff. But I think another question that could kind of be dovetailed off of this, Nathan, is what if you're making the decision to fund more in your IRA versus just taking that money and investing it directly into an asset so you can then take advantage of some of those depreciations? Do you know which one would be a better option there?
Well, that's an individual case-by-case basis, all right? I have a funny approach to it. I sometimes think that you really should focus more on learning how to take your money and make it grow than learning how to shovel too much money in. You will be limited to contribution limits, and I think that you should always try to max out your contributions, provided that you've got enough extra money, right? Always trying to put money into the IRAs makes sense. The tax deferred versus the tax free, how much I should put in, man, that's each and every individual thing. And that's one of the things that bothers me about a lot of the tax advice and stuff that go out there is, I know it's hard to believe, but I haven't always been as rich and good looking as I am, Dan. I know that I had struggled in my life. And I remember talking to some people early in my life, and they're like, well, you just need to be saving more. And I said, really? Should my kids be eating less? There are some practical things that they're just like, oh, no, you need to save more. You need to put this. You need to put, really? Because my kids need to eat too, So I think that sometimes out there that there's this thing where you're trying to shovel and you have to save so much money. I think so much more importantly is though savings is important, learning what you can put into contributions, but where most people miss the game, where most people don't do it, is they don't put enough time in their education on what they're investing in. It makes so much more sense to just make more money with the money you have than work really hard and put more money in. I don't know. That's the way I think.
No, I agree with that. And another question coming in from Gary Ball here is can anyone open a self-directed IRA and move W-2 employers' 401k funds into self-directed IRA?
Well, No, not anyone. First of all, you do have to be a U.S. citizen, U.S. earned income. You don't have to be a citizen, but you have to have a social security number with U.S. income. But I think that's described to that. There are limitations to it. So with 401ks, you could move it in, but where the limitation comes in often is with your employer plan. For example, my employer plan that I have for my employees at Quest is we can't take out partials or in-service withdrawals. In other words, while they're employed with me, they cannot remove money from the 401k. And that's often the case, is you can't, if you work at a company and you're still employed there, the plan documents that the company uses may not allow you to remove any of that money while you're still participating in the plan. Obviously, you want to participate in the plan because the employer is giving you free money, and we never want to turn around free money, so that doesn't make sense. But here's the real thing that you want to do is everybody should call their human resource department and say, hey, can I take, or what age or what time can I take in-service withdrawals from my IRA? What does that mean? Well, that means that I'm still in service, I'm working, and can I move some of that money to my IRA? The answer might be after 10 years of service, after the age of 50, after the age of 55. It can mean it's different in every set of plan.
After you're fully vested.
After you're fully vested. Yeah, there is, yes. Or never, ever, ever. Everyone's different. But if you ever have that option of moving your money out of a 401k, other times that option comes is if any company ever buys your company, they must give you an opt-out at that time. Or if you ever transfer to another company, never, ever, ever put those funds back into that 401k. Always move them to an IRA. I'm not saying a self-directed IRA. You have an IRA with your normal custodian. You'll have more control over that funds as to what you can do with it, and it will be better protected. So I always say, as a good advice, always try to be moving the money out of your employer plans and into your personal IRAs, either traditional or Roth.
So Skylar has another question here. It says,
sure.
You stated that if you are the sponsor and want to invest, you shouldn't use your self-directed IRA. So his question there is why?
Well, that goes back to if you watch the parts with the disqualified persons to you. If you're the sponsor, I'm assuming that you're doing this for a purpose, which is making money, right? You're going to pay yourself money. I would consider money that you make a benefit to yourself. So if you invest in a way that allows you to make money, you've done what's called a prohibited transaction. Prohibited transactions can be some of the highest area of fine laws. Would you like to hear an example of a prohibited transaction? This is my fear slides. Whoa. I had a guy, he had a $1.1 million IRA. He didn't believe me. He took $100,000 and invested that into a commercial property where he was at. About 8 years later, Uncle Sam came back and said, oh, that was a prohibited transaction. You're subject to a prohibited transaction penalties. Guess how bad they ended up being? Because they applied over all the years. The penalties were 162%. Oh,
man,
pretty painful, right? It's worse than that, Dan. The penalties weren't 162% of the prohibited transaction, the $100,000 investment, but 162% of the $1.1 million, his entire IRA, wow. Even though the rest of it wasn't invested in this particular investment. It is the highest fine area of IRS code. So please take my advice. Whenever you're raising money, use other people's IRAs and take your IRAs and put them in other people's deals. That's one of the reasons why the networking works really well. I can take my IRA and I can put it into Dan's deal, and Dan can put his IRA into my deal, and different people do that. It's a great way to raise money. But I don't think that if you're the principal, unless you're going to do it like the one example I showed where the IRA is completely buying the property, all the profits going back into the IRA. There's the debt leverage is held by the IRA, which is an unusual set of circumstances. Most of the time when the IRAs are invested, they're the passive investor.
So I'll make a little plug here along those same lines and say that That's very true. So I have some investments in other syndicators deals that, are there because I couldn't invest it in my own. And I also have other syndicators, actually several other syndicators that have invested out of their IRA and mine, because they call me up and they say, hey, I can't invest my own deal. I know you got this deal.
We do it all the time. That's the truth. It's a fact of how it works.
Exactly. So if you're in that position, you can join me. So you can go to passiveinvesting.com and just type in your information. There's a form to fill out, and I'll put you on our investor list for future deals that we have available. And we actually just got an email while we're sitting here that we're in best and final on a deal. So we just didn't get awarded. We're in best and final on a deal. So feel free to do that if you wish. Lenora has another question here, Nathan.
Sure.
And her question is, do you need to obtain an appraisal of real estate or LLC each year for the IRS reporting?
Oh, that's a great question, actually. And the answer is no, not at all. That's a really tenuous area in my field, because it's becoming hard. The banking regulations are becoming more stringent. Here's the problem is, one of my jobs is I have to report every year to Dan what's inside that IRA, right? I have to tell Uncle Sam how much it's worth. Well, if I'm holding stocks, bonds, and mutual funds, the close of the business day, December 31st, I go to the ticker tape, I look at it, look how many steps, boom, I report what's on there. I have done my job. How much is $100,000 shares worth of an apartment complex worth? Right? We don't know.
Depends.
There's no ticker tape. There's nothing that says it at the end of each year. So what is it that we need? Well, we need to have some types of valuation on an annual basis of the assets that's in there. And I have worked very hard with banking commissions to come up with things to make it really easy. First of all, a lot of the times on the first years, we can accept just a statement just from you. You fill out the fair market value form. Hey, I've invested $100,000. We just began this investment because it hasn't been very long into it. It's still worth $100,000. In a lot of cases, we could use even the K-1s as an investment, right? Reporting Act. But in future years, they do ask for this. They ask that you sign off of the value of the investment and then add some additional documentation. Well, what is additional documentation? Well, it could be as simple as Dan writing a letter saying, I feel that the current value is $73,000. That could be as simple as it is. It really doesn't matter when it's in the IRA, just sitting in the IRA, because it doesn't matter. If it was direct purchase of real estate, I noticed you said real estate, the documentation could be as simple as the tax rolls. And same with commercial things. What's it on the tax rolls for can all be documentation. Those are what we call soft documentation. It's not an appraisal or something like that. There are times you do need an appraisal, and that becomes a little more tenuous with commercial property, certainly. But we don't need to appraise the whole property. We only have to appraise your shares of the LLC. And that's a very rare circumstance. Here's the true circumstances. That's when you're doing a distribution out of your IRA. Well, when would I be doing a distribution? Well, I take the entire house that I had in the IRA and I'm going to take it out and I'm going to deed it to myself so that my daughter can live in it. At that point, then yes, I have to go get a full-blown appraisal. I'm talking about like a residential property, just for the purposes of understanding, and then I'll relate back to commercial property. Okay. Most of the time that doesn't happen, but here's what does happen is we do a conversion from a traditional IRA to a Roth IRA. Now we do have to have a hard value. And if I was talking about just a residential property, that would mean a full real estate deal. That's, again, most of us, we do the conversion in cash beforehand. We would never be facing that thing. In this case, what I'm probably going to have to do is have a third-party expert, somebody like Dan, write me a letter to say why and what he thinks that the value of those shares of that LLC, and submit that with our fair market value form in order to do the appraisal. But again, we only have to go to that level if we're doing a conversion or a distribution out of the traditional IRA. In other words, an actual taxable event. Anything else, we can just get like some documentation, some idea. Different commercial properties, we get different things. But for most people, we can walk through it in a telephone call in about 3 to 4 minutes, and you upload a form and we're done. So, and we do that about once a year with no cost.
Next question is coming from Jamie Arnold. What are your thoughts on the UBIT tax?
I hate it. I don't like tax.
All right, next question. No.
No. So I didn't get into this and because of the time frame that we have. But UBIT tax does not scare me one bit with commercial property. What scares me is that some people do tend to ignore it. And what she's talking about is what we call unrelated business income tax. And it can affect us sometimes as commercial property as we debt leverage property, as we buy property with debt with it. I could do a whole segment on just this, Dan. Here it is. There's tons of solutions to the unrelated business income tax problem, and you just have to pick the one. One of them that I often use or most often use is the use of depreciation, but also I can solve unrelated business income tax with the use of what's called a solo 401k or even structuring like through a corporation. If you want more information about that, I have a class, and my brother has one he calls UBIT You Bet. My class is Problems and Solutions of Buying Commercial Property and Problems and Solutions in Buying Real Estate. Both of those classes, I go into depth of the unrelated business income problem and how to solve it. The real thing is to just get a little education beforehand, and for 9 out of 10 times, it's pretty easy to figure out how to get around a large portion of that.
How long are those classes?
30, 45 minutes.
Would you be able to do a webinar to my group in the future about that?
Sure. I'm happy to talk about unrelated business income tax. It's a little more advanced subject, so I don't throw it out the first time people meet me. I'm already a little bit too endy.
Well, I appreciate you sharing that a little bit. And Jenny, we'll make sure we get him on one of our webinars in the next couple of weeks to share a little bit more about the UBIT. Next question is from Jeff. He says, what about investing on behalf of DAFs, the donor advised funds? I
have no idea I'm not even familiar with them.
Okay, neither am I. So sorry, Jeff, we couldn't help you there. Maybe
honestly, I've been in the private investing field for 20 years now. So the only things that I know about are the things I do, which is I buy notes, I buy into limited partnerships, and I buy into joint ventures. And honestly, I have some private stock. Most of that's getting paid out. That was through a little bank that was there. But yes. I mean, that's all I've done for so long. I don't do any over-the-counter stuff. I don't track that stuff. That's just a different guy.
Yeah. Next one is going to be from Chris. He says, are we still able to contribute a Roth IRA in 2018? If so, how much time do we have to do that?
Oh, yeah. You can always contribute to 2018 up to your tax filing deadlines. So that's not including extensions. So April 15th or whatever. I think it's the 17th this year, something like that. But April, all the way up to April, you can make those contributions, and your employer plans, you can contribute all the way up into tax filing deadlines plus extensions or October for the following year.
And same question, same person asking the follow-up there is what is the maximum income earned in 2018 that you have to stay under to still contribute to the Roth?
It depends on whether you're married or not, and whether you have a plan at work, and it ranges from, I think, 110 to 180. Who cares? And this is why I say who cares. It doesn't matter. If you make too much money to contribute to a Roth, you simply do this. You take that same amount of money, you put it in a traditional IRA. And then with that traditional IRA, you'll get a write-off on your taxes. You immediately, as soon as you put it in, convert it over to your Roth IRA. You can do a Roth conversion, and there is no income limit on the Roth conversion. So it's really just a paperwork problem. I put it in the traditional IRA, I write it off my taxes, I immediately convert it to a Roth IRA, which will then give me a 1099 for the exact same amount. So basically, everybody in America can make a contribution to a Roth IRA regardless of their income limit with the new tax laws.
Next question here is from Sydney. She is asking, how do the principles that you spoke about, the self-directed IRA, apply to federal workers who have TSP accounts? Are you familiar with those?
Yeah, TSP accounts really aren't any different than any other type of qualified accounts. As a federal worker, you're getting money matched, and basically you're building up money in a tax-deferred way. like most employer plans, it's hard to get very much access to that money outside the plan until you've had one of two events. First is separation of service. The second is dying. I highly recommend the first over the second. Dying's not good, Dan. Okay. But separation of service, when you leave your job, when you do finally retire from that job, that money will be available to be moved into a traditional IRA, which can be used into commercial funding. Depending on the branch of government that you're in, you may be able to take some of that money as an in-service transfer to an IRA now. Go to the Human Resource Department and talk to them about what your options are when you retire, before you retire, and any of it that you can move out now, do it. Take it out now. As long as it doesn't affect the cash stream that you're getting. Anytime you're getting free money, you always sign up for that first.
Great. Next question here. Well, a follow-up to Jeff's question earlier about the accounts that you weren't familiar with. He said that the DAF is a charitable account as opposed to a retirement account. I'm not sure if that clarifies it at all.
Same thing. I'm a little bit. I'm familiar enough with them just to be dangerous. It doesn't work under the same type of rules. From what I understand, they can choose self-direction too, but usually they have some type of fund manager that's managing with them. Those are individually managed accounts.
Okay. So. Next question is there a benefit to doing a 72T to access that self-directed money to retire early?
No. You may, if you want to. A 72T means that you're taking the money out of the retirement, and then we're going to still be adding it to the taxable income. I really don't like them because what you're doing is you're making an agreement to take so much money out whether you need that money or not, even if your lifestyle changes. I don't like them that much. I would rather do this. I take the money and invest it while it's still in the IRA. I get it to make more money. I don't have to take it out to be able to buy them any commercial property. I leave it in the IRA and I buy my commercial property that way. And then while it's producing money, if I need some of that money before the age of 59 and a half, then I take it out and I go ahead and pay my penalty on it. I would argue 9 out of 10 people, that thought process will work a lot better than not. If you're thinking of doing that, call up, talk to one of the IRA specialists. You might be able to change your investment strategy in such a way that you don't have to do that as an option. To me, that is a last resort option that's maybe best for people that maybe are terminally ill or different things early in life, picked up a heavy illness. There are reasons to do it. But don't just think that you can throw a blanket over that decision. That's something that you should think about really seriously and talk to multiple people about it. What's cool about it, if you talk to an IRA specialist at Quest, once again, they don't have a horse in the game. They're just going to listen to what you have to say and give you the different rules and where to educate yourself on it.
Next question is from James Gleason. What are your thoughts on borrowing against your IRA rather than taking it out to invest?
You're very limited to what you can borrow against your IRA. All right. First of all, I've never suggested taking out the IRA to invest. I'm suggesting that you leave the money in the IRA and you self-direct it. Rather than directing it to buy a stock of Coca-Cola, we're going to direct it to buy a piece of thing. Therefore, you're not having any tax on it. Borrowing against the IRA is limited to one circumstance. There's only one time you can borrow money against your IRA. And you're not really borrowing money, you're actually loaning the money to yourself, and that's a 401k, and it's limited up to $50,000 or half the value. You have to pay it back in 5 years, amortized rates. That's not really borrowing money. I'm just taking money from 401k and let me have it for a little bit. You can never leverage your IRA or your retirement funds. If you do, that is considered a prohibited transaction and it wipes everything out. So banks know that, and they never allow you to leverage those IRA funds. So absolutely not. You can't do it, and under most circumstances, except for that limited amount in the 401k. And that's not what I'm never, ever thinking that you should take money out of the IRA unless you need it to eat. In other words, I need it to leave money. Why would I do that when I can invest it while it's still in the IRA, let it grow, make money, and then I can eat the money that's growing off of my crops. I don't have to eat the crops, right? So that's how I like to do it.
Let me ask you a question that I have, and you might not know the answer to this. Might be different question that I need to ask somebody else. But when you're talking about a deal that has, say, for example, some of the projects that we have that have self-directed money in as investors from some of our syndications that we put together, and when you're starting to do the K1s at the end of the year, do those losses just get distributed to the other investor? Not the losses, the depreciation. Does that get distributed to the other investors?
It depends on how you've set it up to begin with. And most of the time, no. Sometimes you have a loss of depreciation because the IRAs, they don't get depreciation. They didn't need it, right?
Yeah.
Now, going back to that, most of the time when I'm buying property like that, I am debt leveraged. As I'm debt leveraged, I may incur some taxes to the point that I'm debt leveraged. How do I fight that? I use that same depreciation just like you do. I'm going to use it inside the IRA. So it doesn't really get lost. 9 out of 10 times I'm actually using it, even though it's inside an IRA. I'm still using depreciation because I'm buying a debt leveraged property.
So you can use and we'll probably cover this on that webinar we're going to do in a couple of weeks, but you can use that depreciation to offset the UBIT.
Oh, yeah. But okay, I'll try to give you the synapses.
This is getting exciting.
Really exciting to me in certain cases. There's different ways I use depreciation, but sometimes what happens is guys, I'll give you a little bit about the webinar we're going to do. There are things that create taxation inside an IRA, and one of them is when I'm buying real estate and that real estate has a loan on it. I'm subject to taxation on the profit, but only based on what I'm debt leveraging. If I use depreciation outside my IRA, what I'm doing is I'm pushing that taxation off to the future. I will eventually recapture that when I sell the property, right, Dan?
Yes.
Okay. When I use depreciation in an IRA, a lot of times as I'm using that, I'll use this is only one of the solutions. But if my solution is, or my plan with my commercial property is I'm paying the debt down, I'm not getting more debt. There's different solutions for different ways that we're doing it. But if I'm paying the property down, let's simplify it and buy a residential property. I buy a residential property for $100,000. I put $25,000 down. I debt leverage the rest. I'm 75% debt leveraged. I can use depreciation and any tax that will occur because that debt leverage, I could push those taxation off to the future. But again, I'm only taxed on my debt leveraged amount. So in the future, am I still 75% debt leveraged? The answer is maybe not. Maybe I could be zero. I could have someday paid off that property. If I can use depreciation to push that off until the point that I paid off, how much taxes do I actually end up paying? Zero. Often the problem of unrelated business income tax is simply a paperwork problem and not really a taxation problem if you have the right person and understanding the structure as you put it in place.
That's very important. That's very true. And I think that's also one of the things that you would probably say in regards to whether you would do a self-directed. I mean, it's still self-directed when you do a checkbook control. It's still self-directed and it's still custodian driven. But, what's your thoughts on checkbook versus the non-checkbook self-directed IRA?
It goes back to disqualified persons. One of the biggest checkbook control IRAs, I could talk another hour about this, scare me, and they're going away a lot.
That's another webinar.
Well, there's a lot of things that happen when we're dealing with this a checkbook control. Is remember I told you there's people who are disqualified to the IRA. They include yourself, your spouse, your lineal descendants, and descendants. Their spouses. Here's the kicker: companies those people own, control, manage, or highly compensated by. As soon as I make myself the managing member of an LLC that I'm managing the checkbook, I would argue that that's disqualified. I've been arguing that for 10 years, and Nathan, you're super conservative, blah, blah, blah. Well, guess what? Some people are starting to agree with me, and those are scary people. Okay, one of them is the Board of Labor. About 3 years ago, they sent out a little letter saying that they really didn't like these, and the Board of Labor oversees the IRS. I know a lot of people don't know that the IRS has someone that oversees them, but they do. But here's something that's really scary. In 2018, we now, self-directed custodians, have to report something differently. And up until this point, we used to only have to report the value of the asset that was in there. Now I have to put the value of the asset in there, and I have to tell you if it's a single manager LLC. I wonder why they're gathering that information. I'm a little bit suspicious-minded me, but I would say that they're gathering that information to find people so that they can collect some taxes from them for doing this. No, I wouldn't do a checkbook control IRA. There are exceptions. Once again, there's all types of ways that you can gain that checkbook control, which I'll talk about that with the problems and solution when we do next time. But I'll talk about, we could use the solo 401k, we could use trust, we could use other people to create that checkbook. But most of the time, you've hit on something. Most people just aren't sophisticated enough, and why mess with all of that? When I get done looking at it, the average person ends up spending thousands of dollars to save a few hundred. You know, and it usually doesn't work best that way. So,
next question is coming in from Paul Lombardi. His question is, can you move money out of an annuity into a self-directed IRA?
It depends. Not typically. Annuities are tax-deferred type of accounts that are inside of banks. There are what we call qualified annuities. These are annuities that came from a retirement account or a qualified fund. So the question is, if it's a qualified annuity, and the other thing is sometimes cashing annuity ends comes with a big pain, because that's literally what you're doing. So some people, even if it is a qualified annuity, if I cash it in too early, those early penalties may not be worth the hit. But it's worth exploring. Pick up the phone, call, ask for an IRA specialist here at Quest, and just kind of go over it with it, whether it's qualified or unqualified. We'll have you look at your statements, and we'll be able to at least figure that out so you understand what you have.
Great. Last question here that's come in is from Jamie Arnold again. He says, crazy question, but what if you convert your traditional to a Roth and need to pay taxes on that? Would the loss you see in the self-directed help offset that, or no?
No, not typically. There are exceptions to that rule, but sometimes and you don't really want to fall into those exceptions, because that means you really lost a lot, you know. So we want to try to avoid that. That's an exception that we want to avoid, but no, not typically. In the past, up until last year, what we used to do is we'd do the conversion, and if the investment wasn't quite doing as well as we thought, we would recharacterize it or say, oops, I really didn't mean to do that conversion. We'll just pretend like it didn't ever happen. We were allowed to do that up to a year and a half later after the conversion happened. Now they took that away from us. You do a conversion, it's done. It's like, it's a little bit more scary now. You've got to put your big boy pants on. You're going to be taxed on that whether that investment goes up or down, unfortunately.
So a question that's I'm thinking of right now is, when you have an investment that you're trying to use some of your self-directeds on, and let's say the minimum investment on the project is $50,000, okay? Right. What if you only have $25,000 that you want to invest out of your IRA, but you also want to invest another $25,000 alongside your IRA? Is that still okay as long as you are both?
That would be fine with me. Yeah. And this is why. Because what can't you do? What can't disqualified persons do? You and your IRA... Ooh, that one made me sneeze. Sorry. You and your IRA are disqualified from each other. You said, Nathan, well, you said you can't do things. You can't buy, sell, trade, and extend services. That doesn't mean I couldn't partner in. You put your half in, and I put my half in, right? And then when money comes back, you get half, I get half.
As long as you're not controlling what's happening with it.
That's right.
Either one.
And you're not doing what we call disproportionate distribution. In other words, moving more money from one to the other. The amounts of percentages you put in are the amounts that come out. I have seen, not often, most of the time, you know, we're looking at a person, they meet the criteria to do the investment. It doesn't matter to them whether it's coming from the IRA or personally, but I have seen certain syndicators not get it and not want to treat it like two different people, or in other words, I didn't have a problem with it. The client didn't have a problem with it, but the attorney putting the commercial problem thing for whatever reason did. It messed up his paperwork in such a way. I've had that happen a few times, but not very many. I've seen that.
Yeah. Well, I think what you'd have to do is still make sure you met your minimum threshold, because if the minimum investment, according to the PPM, is say 50,000, then you couldn't do 25 and 25. You'd have to. A lot of syndicators will say 50,000, but they'll put the minimum at 25. And in that situation, both of you could come in at 25 each, right, if the syndicator approves that. But if your PPM says minimum's 50, you can't accept two different entities less than 50. You have to do it based on that, and that's probably where the hiccup comes in.
Yeah, I've had people like allow it to get through because it was the same person. They were able to, but like you said, that's where the hiccup is. Sometimes it's not with me. It's with usually if it's all IRAs, like my IRA and my wife's IRA, they don't have a question because they're reporting back to one EIN, which is Quest EIN at that point, So,
so last question here is about your company, Quest Trust. The question is, how long is the turnaround? Because I've dealt with some other IRA companies that that are custodians for investors that we've had, and it has taken weeks. I mean, one took like 4 to 6 weeks to turn it around, and somehow the check didn't get cut, and 3 weeks later we still don't have it, and they ended up just finally wiring the money.
There are inherent problems with self-directed IRAs, and I can only address the ones that I have control over. Now, I've worked really hard to speed up every system that can be speeded up. If I have control over the money, it's not unusual that if you got me all the paperwork about 9 o'clock that morning, by noon that day, I could have that invested and funded. What are the hiccups in there? What are the things that slow it down? The biggest thing is typically getting the funds from the other custodian. Who's got them right now? How fast you can open the account and move the account in. Some of them move very fast. Some of them can be very onerous. And a lot of times it looks like it's us that are dragging their feet because we're the ones that are always calling and whatever. And really it's the other one. Some of them are really good and really fast about moving the money. And that is different between different institutions. So most of the time, the thing that slows it down isn't any of our systems, but it's trying to get the money. The second problem is maybe some communication differences where we have a vesting wrong. Some syndicators, you'll know this, Dan, are very responsive. Like, oh, hey, this is wrong. We got to change this from Quest IRA. It needs to say FBO and some other stuff on it or something like that. And they fix it right away. Other ones, it's like they put it back in and it takes them a month to do the most minor repair in the PPM or whatever. So sometimes that creates a problem. But if everything's right, I have control of the money. Dude, nobody's faster. Nobody.
Well, that's what I've heard from multiple people, including Scott Carson, who connected us, and he definitely suggested and recommended that I get on with Quest with my own IRA. So I'll definitely be giving you guys a call to be able to get that process started as well. And anybody else who's interested, you can go to questtrust.com, reach out to one of their advisors, and they'll be glad to help you out as much as you can. Well, Nathan, do you have any final parting words before we go?
No, I just appreciate y'all taking the time, learning something a little bit new. I'll look forward to the next one, Dan.
All right. Well, thank you so much, Nathan. Looking forward to it as well. Hope you have a good rest of your day.
You too. Bye-bye.
Bye.